All right, can you pull it up? All right, it's 5 o'clock. Let me make sure I'm locked in here. Make sure you can see me. Boom. All right, perfect. All right. Whoever's watching, thank you for watching. Today I'm gonna go over a few things. The same disclaimer as last time. Trading is risky. 97.5% of all day traders lose money. I'm not offering financial advice, which is what a whole bunch of people say. I'm sharing my personal experience, knowledge of the stock market related activity. I just want to begin today with I'm not into motivational speakers per se, but I do want to do a little motivational moment. So I want you to. I don't even have to. I thought I was going to have people close your eyes, but I want you to think about where you are in your life, like financially, socially, even though COVID right now, just choices that you've made over the whole period of your life that have kind of culminated to this point of where you are right now. Um, just kind of look back and think over those things, um, and and just realize like where you are right now, especially financially, because what we're talking about is finances. Where you are right now is a result of those decisions that you made. And some of those decisions, especially now I'm talking about me, a lot of these decisions that I made weren't necessarily my decisions. Like I went to work for an employer. Obviously, I worked for how much they said they were going to pay me, but they made a lot of decisions. I allowed my employer, or I allowed others to make decisions for me. So when am I going to come to work? How many hours I'm going to work? What extra days I'm going to work? What all these other things. So what I'm trying to provide is information that I'm not saying quit your job. I'm not saying people shouldn't be employed. I'm not knocking being employed and working a job. I'm just saying the information that I'm trying to provide for you can kind of give you the pen back so you can be the author of your own life. And write, actively write some of these decisions instead of kind of just being passive in your own life. Um, I'm not gonna sell it to you like it's a dream, like you're gonna make millions of dollars. But you can make all your bills. When I first started trading on Robinhood, uh, I would be happy to make my lunch that day. So I would go to Chick-fil-A. So I was trading, I had like $100 account. I was happy to make like $12 a day. So you can make this fit your life. You don't have to make as much money as I do. I just want to start with that. And if that's the type of information you want, then you can continue to rock with me. I'll put up more videos. I'll start this at 4:50. I was a little bit late today. I'll start talking at 5. I'll put out some short videos, some real short topical videos. Like today we'll talk about options. I'll go a little bit deeper into options on a shorter video directly on that. I'll do something on the PDT rule and other stuff throughout the week so that if you don't want to watch this whole thing, you don't have to watch the whole thing. All right. So we're going to go over some terms to know, some new terms to know, some I didn't review last time, and then some pertaining to today. But first, we'll get to some questions. Can you trade my money for me? No, I cannot trade your money for you. I am not an account manager. I don't even think legally take your money and control of your account and trade your money for you. I don't even have time because I have to trade my own money. So I don't have time to trade someone else's money. It's not that I don't want to do it. I'm not a money manager. Can you give your money to me, add it into my account, and then you benefit from my trading? Again, no. If I have a $4,000 account, you give me $1,000, right? And are you gonna be willing to take a 20% hit if I take a 20% hit? And then what if I go into a trade but I only use $4,000? Do you then profit off it? It's not manageable. It's not something I can do. We cannot put our monies together and then trade. Do you have to quit your job to do this? No, you do not have to quit your job. I'm not advocating anybody go out and quit your job. This is something, and we'll get into market times. This is something you can do on the side as you're at work. You don't necessarily, and that's one of the questions too. You don't necessarily have to trade like I do. Somebody asked me is what I'm doing like Chris Sane and others. I looked a little bit at Chris Sane. If you notice videos like his and like others, these people are going over. There's two different types of trading. There's fundamental and there's analytical, and they're almost doing kind of like a fundamental. One, they're doing it on the phone, which I told you is viable. It's just not viable doing it the way I do it. And two, they're going over stocks to trade for the next week. So I'm pretty sure last week a lot of eyes were on NIO, because it was an electric vehicle. The week prior, it was in the upward trend, especially with Tesla. So all eyes were on NIO and FCEL. They didn't really move that much. But these people are giving you, I mean, they say it's not financial advice. It is financial. At least I see it as financial advice. These people are telling you stocks to look at based upon news or based upon whatever reason. I'm not geared towards that. I'm geared towards something not totally different. I'm geared towards something a little bit else. And it's kind of like this. If I'm a quarterback and you're built like a running back, right? You have all the athletic build, you have the talent for a running back, but you don't know anything about football. I will teach you the game of football. I'll teach you about first downs. I'll teach you about a knee pad, what a football looks like, what a touchdown is, what a field goal is, what a PAT is, what a safety is. I can teach you all this stuff, and you'll know the game of football. All right. After you know the game of football, if you want to be a quarterback like I am, I can teach you the more in depth about what it means to be a quarterback. But you're not a quarterback. You're built like a running back. All right. You can take my information that I'm giving you about how to play football and apply it to being a running back. So you can take the information I give you and go listen to somebody like Chris saying and trade like that. You don't have to trade like I do. You can do something called swing trading, where you just trade because most stocks go up, down, up, down. You can just buy the lows and then trade the highs and do that over a period of days. You don't necessarily have to come to the stock market every day and look at it. You can set a stop loss or a trailing stop loss, and then you can buy, and then it'll sell it for you when if it goes too low, and then it'll sell it wherever you wanted to exit the position going too high once you gain, or going higher once you gain the money that you're looking for. You don't necessarily have to trade the way I do, but the information I'm going to give you is going to allow you to play the game. All right. That's all I'm trying to do. I'm trying to give you the information to get into the stock market. All right. How and what you do inside the stock market is totally up to you. All right. You don't even have to fool with it. All right. And that answers kind of the question. Do you have to trade like I do? No. Why do I trade the way I do? My cousin asked me that. All right. I trade the way I do because that's how I learned it. It's just that simple. Typically when you learn how to do something, you do it that way until taught otherwise. All right. I learned from people that I look at, people that I watch. I learned momentum trading, and a lot of strategies like first candle to break a new high, first 5-minute candle to make a new high, buying a dip, buying a bounce off a VWAP or 200 EMA or standard, the upper or lower standard deviation, like all this stuff it's stuff I've learned, and then I've just kind of molded it into how it fits me as a trader. Do I trade just like every trader I watch? No, I don't. But a lot of what I looked at, it originally influenced me. So that's why I trade the way I do. I don't do long-term swing trading. I think I could do it, but then I would have to learn something new. And at this moment, I'm not trying to learn anything new. I'm trying to master what it is that I do. And then once I have that mastered, then maybe I'll go into trying to actively trade in a different way. All right. So let's get right to it. All right. Terms of no, a bid. Imagine it's just like if you go to an auction, all right, you have people in the audience who want the item that is up for bid, right? The bid price is the price that buyers are proposing to purchase a stock, right? So you have a bunch of people in the audience saying, I'll pay $5, I'll pay $6, I'll pay $7, right? This is called a bid price. There's something called an ask price. There's ask price is the price that the person who's selling, I don't know why I put buyers. I should have put sellers. The price that sellers are proposing to sell a stock. I'll put buyers, but it's supposed to be sellers. All right. So in a spread, which is is right here. A spread is the range between the bid and the ask. So you may have people who say, I want to buy it for $6.05, right? And those are the bidders. The sellers may be saying, no, I will sell it to you for $6.07. All right. The spread between that is 2 cents. All right. And the fill, all right, the fill is the price that you enter into or exit from a position when you elect to buy or sell, all right? So if I'm a buyer and I put in my bid is to buy a stock at $6.05, all right? And they're saying, no, we want to sell it at $6.07. Because understand the market, there has to be if you're buying a stock, someone has to be selling it. If you're selling a stock, someone has to be buying it. You can't sell something to the market. You're selling it to an individual or an institution, but it has to be a buyer or a seller on the other end. All right. So if they're saying no, $6.07, all right, they may come down and say, all right, we'll sell it at 606, or okay, hey, I just want to get out of my position. We'll sell it at 605. That is the fill. So I can put in, whenever I'm purchasing a stock, I can put in to buy at the ask price. right? And I can put in to buy at the bid price. If I buy at the bid price, I'm going to have to wait. The reason why I'm going to have to wait is because everybody's bidding, right? So I'm joining the listed. So if it's 1,000 bidders bidding at $6.05, I got to join with them and I got to wait to get filled. If I put in for the ask price, I'm more likely to get filled quicker, meaning I'm more likely to get my transaction across, because if they're saying, hey, we'll sell it for $6.07, and I'm saying, yeah, okay, I'll buy it for $6.07, our transaction is going to go through immediately, usually immediately. All right, this is what you do whenever you're trying to get in quick. All right. If I'm willing to wait or I'm not willing to fluctuate on my price, I'll hit the bid. And the fill is just where you get filled at. So sometimes you get something called, I should have put that on here, slippage. We'll talk about slippage. Market price is another thing. Market price, this is if you remember, I said with Robinhood you get bad fills. Usually with Robinhood it does a market order. A market order is just kind of, is where your broker just sells it at whatever price it can get for it. So if again, it's if I'm a buyer and I'm electing to buy it at $6.05, they're selling it at $6.07, and I say, okay, I want to get in, right? So I put a market order in. It may fill me at $6.25 because there is a seller somewhere who's selling it for $6.25. So a market order can get filled really high when you're buying in, and also when you're trying to get out of a position. So if you're trying to get out of a position and you're trying to sell for $6 even, right? And you're saying, okay, nobody's buying at $6 even, let me go ahead and hit a market order so I can get out. Well, it can fill at $5.75 or $5.50 or $5.20. All right, you very rarely want to hit a market order unless you're desperate to get out of a position, because you can get really bad fills or a lot of slippage, which can result in losing a lot of money both ways. Because if you get filled high going into a position, buying into a position, then what's going to happen is you're going to have the price of the stock is going to have to move higher in order for you to get more money when you sell it. And on the opposite side, same thing. All right, time and sales. I'm going to show you some of this time and sales. It's also called reading the tape or the tape. There is I have to show it to you. There is something that you can look at, and it shows every order that's going through. And so it scrolls. It scrolls really quickly too. It's like 1,000 orders, 5,000 orders, 500 orders, 600 orders, 617 orders, and it shows a price, the time, and then it shows colors. And it'll make more sense when I show it to you. It shows colors. Usually it's red if it's below the bid, and then it's usually yellow if it's between the spread, and then it's like green if it's above the ask. All right, and this lets you know if there's a bunch of orders going through and they're all red. It lets you know that people are really just trying to get out of their position, and that the price is probably about to fall. If it's all green, then okay, people are willing to pay more than what the price of the stock is, so it may be a good time to get in. All right, and level 2 is almost like the tape, except it's not orders that have been completed yet. So on level 2, it can say that there are. It'll show both. It'll show on one side, it'll show the buyers, how many buyers there are, what price they're willing to pay, and not how many, but how many orders there are. So, and it'll show 1,500 orders at $4.60, and then on the other side, it'll show the sellers. It'll show somebody selling at $4.65, and it'll have how many sellers or how many sell orders. 500 sell orders, 600 sell orders. All right. This is what level 2 is. This is something I have to read. I can't really I look at the chart, but when I'm actively going into and out of a trade, I'm looking at the level 2 because I'm looking at what's about to happen in the market. All right. I look at this tape to tell me, all right, what are the orders going through? The orders going through are kind of yellow and the green. All right. I see that. I'm looking at a level 2. There may be a big buyer, or I'm sorry, a big seller at $4.50. All right. And I can see that because at $4.50, it may say that there's a seller and he's selling 50,000 shares. All right. I'm not going to buy at $4.50 because there's somebody there selling at it. I mean, I don't want to get to economics, but I mean, it's based on supply and demand. All right. So if somebody's selling a lot of the stock at a certain price, it's going to be really hard. It's going to take, if he's okay. So for example, if there's a 50,000 share seller at $4.50, it means it's going to take 50,000 shares of buying to get over $4.50. All right, that's a lot of buying. So if I see that coming up on my level 2, then I'm probably going to get out of my position, because chances of 50,000 shares of buying going through to get over $4.50 is not very likely. And so that lets me get out of my position earlier than somebody who doesn't have level 2. Again, Robinhood does not have level 2, as far as I know, does not have level 2. Webull does not have level 2. So you may be getting into a position on Webull or Robinhood thinking, oh man, this thing's going up and up and up. All right, I'm looking at it going up and up and up on the charts. I'm looking at the time of sales going. I'm looking at tape, and then I see on the level 2. Well, okay, it's going up and up, but at 488, there's a seller, and he's selling 100,000 shares. It's going to go up, but it's not going to go past that. At least not the first couple times. So I'm going to get out of my position, and by the time you see everybody getting out of their position, it's going to be going red for you. So that's why I can't do what I do on the level 2 or my trading on Robinhood, because I need a level 2. That's not to say you can't do swing trading or maybe like we'll talk about options trading. You don't need options. You don't need level 2. You don't need to tape. You need some of the, you need to know some of this stuff, but you don't need that. All right, parabolic. I need to talk about this because somebody may use this. Hopefully, if you're really interested in this, you're taking the information that I'm giving you and you're going and looking up some stuff yourself and you're bringing questions. Parabolic just means that it's like moving up, 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 and up. I'll show you a picture of parabolic. Hold on. Let's look at parabolic real quick. This was parabolic the other day. All right. So this is the wrong chart. Hold on. This is parabolic. All right. This traded on this right here. Traded on let's change the time frame. Let's change it to 10 minutes. Oh, really? Here, let's go back to the 5 and hope it doesn't freeze. All right, 5 is fine. All right, this is parabolic. Hold on, let me make it bigger. This sudden move right here from $51, all the way up to $73. This happened on Friday. That's parabolic. All right, when somebody describes it was moving parabolic, they mean it was just going up and up and up and up. I mean, you had a few little dips in here, but for the most part, up and up and up and up. That's parabolic. All right. All right. All right. And hedge. The reason I'm talking about hedge is because you're going to need to know what I may use the term hedge in talking about options. Hedge is when you protect. I mean, if you think about a hedge, you have hedges around your house. All right. It's to protect. It's usually for. I mean, people don't really use it for protection. They use them more for privacy, but it's to protect the risk of your assets. All right. You can hedge yourself with the options. All right. You have the pre-market. Pre-market, again, you don't have to. The reason I say you don't have to quit your job, you're like, oh, I work a 9 to 5. I can't do this. All right. You have other market hours. All right. You have pre-market trades from 4 a.m. to 9:30. All right. Market opens. The main market opens at 9:30. Market closes at 4 p.m. You have post-market trading at 4 to 8. All right. So with pre-market, it's not as much volume. Meaning that if you're going to take a large position, it's hard to get in and out. So if you're buying 10,000 shares this early in the morning, it's going to be hard. Well, it may get hard to get filled 10,000 shares, and it's going to get hard to get out 10,000 shares without having slippage. But you can trade these hours. Like if you want to trade from 4 a.m. to 8 because you got to go to work at 9:30, trade 4 a.m. to 8. If you want to trade post-market because that's the time you have available, trade post-market. If you want to trade between trading days, trade between trading days. You don't have to trade the market. Most of the volatility in the market, though, occurs from about 9:30 really, 9:30 to 10:30, maybe 11. All right, that's most of the volatility and most of the volume in the market. That's why most people trade in the market. All right, and 2 more terms, and these pertain to options contracts, which is what we're going to talk about today. In the money means pertaining to options contracts describes the value of the contract. In the money means the price of the stock is above the strike price. We're going to talk about what the strike price is for a call option. I have call option 12. Yeah, that's right. Above the strike price for the call option. And below the strike price for a put. All right, and out of the money just means is the value of the contract. So basically, what these mean is in the money means that the contract is actually making money right now. All right, and if you buy that contract, you're gonna pay a higher premium because the contract's already worth something. All right, out of the money means the contract's not worth anything yet, um, and so you're gonna pay less for the premium of the contract. Let's talk about options. All right. All right, this is really for people who I know I talked earlier in my first video. I was talking about, and again, it was just for me. I think I was talking dismissively about making $150 a day. All right, $150 a day doesn't really fit my life, just because I have the family support. But $150 a day may be great for you. I mean, it's what $750 a week. That's great. $750 extra income a week is great. Again, like I said, I was trading in the beginning just to make lunch money. So, so, like just because I just said that because I didn't want to be dismissive of people. I didn't want to be dismissive of smaller account size or coming in with larger or a smaller amount of money or um, try to what's the word, shade people who aren't making over $150. I mean, you make $10, it's $10 more than you had. All right, now options trading is really beneficial to people with smaller accounts because well, we'll get into options trading and you'll see exactly why. If you're not trying to invest a lot of money in the stock market, or you're not trying to or you just don't have a lot of capital to begin with, you don't have enough capital to start with $2,000, but you have $500, you have $100, you have $50, you can buy an options contract and you can make a lot of money off of options contracts. And so let's talk about them. They allow you to purchase a contract to either sell or buy a security. A security, again, is just a stock, is what we're talking about. Uh, okay. Um, at a certain price called a strike price, is what we talked about earlier. In the future, options contracts are purchased as either a put or a call. All right. And you pay, when you buy a contract, you pay for a premium. All right. You don't actually pay for the stock, but you pay the premium. All right. And the options contracts are for 100 shares of the stock. So if you buy an options contract for Microsoft, it's going to be for 100 shares of Microsoft. You're not going to pay for 100 shares of Microsoft. You're going to pay for a contract of 100 shares of Microsoft. And we'll talk about how this works out in a second. All right. And these things have expiration dates. The longer they are, like how, in terms of, there's one that expires on February 1st and there's one that expires in March, is gonna reflect in the price. All right, you're gonna pay more for one that expires in March than you are for one that expires in February, because it's much less likely, or the volatility between now and March and now in February are going to be significantly different. And the value of these is what you're going to talk about, which is actually the next slide. Actually, let's you can impress your friend, is you can talk about derivatives. If you've ever heard about people trading derivatives, derivatives also are future contracts. Futures are just like options, except futures don't have options. Like if you buy a futures contract, you have to go buy the 100 shares of the stock. This is an options contract. It allows you the option to buy and sell. And we'll talk about that in a second. But these are called derivatives, as the value of the contract is derived from the underlying value of the stock. So the value of the contract is based upon the expiration date of the contract, the volatility between that, and then there's some other stuff that goes into determining the volatility, and then the stock price itself. All right. All right. And then you buy them in two ways. All right. You can buy a call. All right. A call option. And this is where I do love Robinhood, because Robinhood's interface is wonderful on options. If I remember correctly, when you go into options, it will ask you, do you think the price is going to go up, or do you think the price is going to go down? So it kind of guides you into buying the right security, or the right option. So that way you're not buying something with the intentions of it going the other way. And then you're losing money. You're wondering, why am I losing money? I thought it was going to go this. Well, you did think it was going to go that. It did go that way, but you bought something saying it was going to go another way. All right. A call is when you believe the stock price will rise. The contract allows you to purchase said stock for the strike price in the future. All right. And we're going to have an example. So all this is going to make sense. All right. And the put is just the opposite. All right. If you think the price is going to go down, it allows you to, I should proofread these. That should be sell. So let me edit that right now. Actually, hold on. All right, because I want this to make sense. And hold on. All right. All right. So the put allows you to sell the stock in the future at a certain price. All right. A little bit different. And for a call, it allows you to purchase at a set price if you think it's going up. A put, if you think the price is going to go down, it allows you to sell at a certain price. All right. And options contracts are not required to be exercised. Again, it is an option. All right. The owner of the contract may allow it to expire and is not required to purchase or sell the 100 shares of the underlying stock. So if your contract is for December 32nd, which is not a real date, right? And December 32nd comes and your contract is about to be up, you can just let it expire if it's worthless. If it's worth something, then you can just sell it. Somebody will buy it if it's worth something. Or you can exercise it if you need to hedge, if you wanted to hedge yourself, or you were doing something covering call trading, which is something a little complicated. I won't get into it. I'll do a short video to talk about it, but it's too complicated. I'm just trying to get you introduced into these terms so you know what's going on. All right, so let's talk about an example. All right, so GME. All right, that's the stock we were just looking at. All right, this is a call option. So this, I believe the stock is going to go up. All right. I don't have enough money to buy 100 shares of GME at $45, right? Because I would need, that's what this says. In order to purchase 100 shares of GME, you would need $4,515. I don't have $4,515. You know what I have? $100. All right. All right. So I expect the price will rise. I purchase a call option. All right. I purchase it, and the strike price. Now, the strike price is 50, and we're gonna talk about the strike price. The strike price is non-negotiable, but you're not locked into a set strike price in terms of every strike price is not going to be $50. If $50 is too high for you, if it's at $45.15 and you don't think it's going to make it to 50, all right, don't buy an options contract with a strike price of $50. Try to find one with a strike price. If you think, say you think it's going to go to 48 and that's it. All right, try to find one with a strike price of 46. All right, price may be a little bit different, but try to find one that's below this price, because the strike price is going to be the price at which you can exercise this call. All right. So let me explain it. All right. I expect the price will go up from 45.15. All right. I am expecting it to go up. Me personally, I'm expecting it to go up to $55 because I've done my research. I've looked at some charts. I looked at the daily levels. I think it's in the upswing. I think it's trending up. I looked at some news, all this other stuff. All right. So I think it's going to go to $55. So I find the options contract and the strike price is $50. Perfect. Great. All right. It expires on February 1st. Okay. I'm comfortable with that because I think by February 1st, it will at least have made it to $53. Okay. And what'll happen is when you go to buy this, it'll have a price. All right. It'll say 12 cents. Now this is cheap contract. 12 cents, 15 cents, $1, $2, $3, $4. It'll have a price. All right. You take that price and you multiply it by 100. All right. So 12 cents times 100, $12. That's how much the premium is. That's how much you're going to pay for this contract. All right. So the contract that you buy for $12, which is the premium, all right, what it does is it allows you from now until February 1st the ability to buy 100 shares of GME at $50. Okay? You don't have to, but if you wanted to, you could have the option to do that. All right? All right. Again, after it's 45 cents, I expect it to go up 12% per contract, right? I pay $12 the premium. The $12 is taken from the 100 shares times 0.12 cent. 12 cent is the price that is listed for the per contact for the contract. All right. It expires February 1st. I think that's an okay day. I think it'll make moves by February 1st. I'm okay with that. All right. And the strike price is $50, meaning if it doesn't make the $50, if it's February 1st and it's not $50, it's worthless. All right. That's what this is talking about. If the price of GME doesn't rise above $50 by February 1st, the contract expires worthless. The most money you can lose on this is $12. All right. That's the beautiful thing about options is I'm not risking all of my capital, right? But I'm purchasing 100 shares, right? So I'm potentially buying 100 shares at $12 as opposed to $4,500, right? This is how you can make a lot of capital in the beginning of your trading career or doing whatever it is you want to do, or just make a lot of money on the side with a little bit of money. All right. I know somebody that did this and made like $70,000 on GME because it like went crazy. I think it was like $7, $27 a contract. All right. He bought 17 contracts for $27 and made a lot of money. Anyway. All right. The only thing that you can lose is the premium, $12. All right, so let's talk about if it goes up, if you make money. All right, and this is when I'm talking about you can make a lot of money off of a little money. The price of GME does rise to just $51. So the strike price is $50. All right, if it goes to just $51 before February 1st, you will make 88 cents per contract, which is 88 cents times 100 shares, right? All right, it's like $88. You take that $88 and subtract the price you paid for the premium, and you made 76 freaking dollars. All right, you made $76 off of $12. All right, you didn't need to have the 4,500. You just needed to have 12, and you made $76 just because it went up $1 above the strike price. It didn't go. It went up totally $7. All right, $6. I'm tripping. Well, $5.85. But because it went up $1 above your strike price, you capture $76. And let me tell you why this works. All right. So what happens is you own a contract that says you can buy 100 shares of GameStop. That's what GME stands for, GameStop, at $50. All right. But right now it's trading at $51. So if you exercise the contract, what would happen is you would have to come up with this amount of money. All right. You would have to, well, technically you have to come up with $5,000 because you would have to pay all of this. You would have to buy all of that at $50. So you would have to buy 100 shares at $50. You would have to come up with $5,000 if you exercise the contract. You have to come up with $5,000. You would be guaranteed to be able to buy all the shares, but immediately you could go and sell all those shares for $51. And that's the beauty, is that because it's trading that day at $51. So that's the money you can make. All right. So imagine if it does go to the 55, it goes higher and 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 higher. All right. So next example, our puts work the same way. We'll go over puts real quick. Puts work the same way, except it's going the other way. If I expect the price to go down, this is literally the same example, except it's going the opposite way. Is if you expect it to go down, right? 45.15. I mean, it's literally the same example. There's really no need for me to go over this. You make the same amount of money. All it is just it helps you in a small account or with a small amount of money to make a lot of money. I don't see any questions. I don't have much more to go over. I can't think of anything else to go over. I hope that explains options very well. If you have any questions about options, of course, you can hit me on my phone. I'll be doing 1 minute, quick 5-minute videos. I'll post them to YouTube and I'll post them to, I made a Facebook just for this. I'll post them to the Facebook and then you can track it on Facebook. But I hope that explained options contracts very well. There's a lot more to options than I just described. Again, like if you can hedge all right, we'll go back since I've got a little bit of time. All right, we'll go back. We'll talk about this call option. All right. So let's just say, actually we need to go to a put because that's how I'm going to cover myself. All right. So if I actually have 100 shares, and this is a little bit more if somebody's doing this, they don't need to look at this example. They're not watching me or beginner information to do this, because this is something you do whenever you already know what you're doing. All right. So let's just say I have a $5,000 account, right? I go and buy 100 shares because I believe that GameStop is going to go up, right? But $5,000 is all I have, right? And I believe it's going to go up. So I buy 5,000 shares. I'm sorry, I buy 100 shares of it. It costs me 4,500. It costs me almost all my money, all right? And so I'm 45.15 in, and I want to protect my investment, all right? This is how people hedge themselves, all right? Or they hedge their investment, all right? You can, with this, you can go buy your 100 shares at 45.15, spend $4,515, all right? And then you can go and buy a put contract, all right? And you can buy a contract that will allow you to sell all of your shares at $45.15, all right? At $12, all right? Now, here's what happens. If it goes up, let's just say it goes up to $100, right? Boom, you made a lot of money because you paid 45.15. It went up to $100, which means it went up 55 or $54.85, which means that's how much you made times 100, which means you made another $5,000. Like, yeah, I think $5,000. All right, so that's how much money you just made. Lovely. All right, and the most you're going to lose is $12. Because you paid for the contract saying it was going to go down, right? You covered yourself, and it'll make more sense when I give you this part of the example. All right, you're going to lose because this contract is going to expire worthless because it didn't go down; it went up. You bought a put contract thinking it was going to go down. All right, you really did think it was going to go up, but you bought the contract to cover yourself, and the contract said it was going to go down, and it didn't go down; it went up. So you just lose $12. All right, it's fine. You lost $12, but you made a lot of money. All right, let's just say you buy 100 shares again of GameStop. I know I'm like saying the same thing a lot, but I just want to make sure these examples are clear. You buy 100 shares of GameStop. You pay $4,515 for it. All right. But you want to cover yourself. You want to make sure that if it goes down, you don't lose all your freaking money because you only have $5,000. And if this goes south, if you lose 2,000, it's going to go way south. And maybe you have a job and you're not able to monitor it. All right. You're not able to look at your phone all day. All right. You're not able to wake up at 4 o'clock and check it pre-market and make sure it hasn't dipped. All right, whatever the reason, you don't want to lose all your money, so you buy this contract, and let's just say it does go down. It goes down from $45.15 all the way to $20. Let's say it goes $10. Right, the value of your account is going to be crap. All right, it's going to be super low. All right, but thankfully you bought this contract. All right. And the contract said that you can sell 100 shares of this stock at the same price you bought it for. All right. So what you would do is you would exercise this option. This is what you would do. You would exercise the option. And what you would do is you would be able to sell 100 shares of the stock that you bought at the price you bought it at. So you would cover yourself. You would not lose any of your money, which is great. And the most you lost was $12. All right. This is how you can cover yourself when you're making large investments into the market. When you're swing trading, you can cover yourself. But this is what you're doing usually if you have a lot of capital or you're investing all of your capital into something you think is going to be a home run. All right. And you're okay with the price of the premium. Now, the price of the premium is not always super low. It's not always $12. Like I looked at the contract for an option for GameStop. Actually, Friday today it was going up, and I think it was going to cost either $1,100 or $11,000. I can't remember. One of the two, $1,100, $11,000. Right? They're not always cheap like this, but it's going to be much better to protect yourself from losing $45. Even if it was $100, even if it was $200, right, for this contract, it would be better than losing all $4,000 or almost $2,000 or $3,000 worth of your money to buy the contract to protect yourself. All right, and then if it goes up, If it goes up and you're over $300 in profit, then you start actually making money, and that's okay. But that's how you can protect yourself. And there's some other trading strategies that you can do whenever you can make money on off the premiums of selling. Like if you sell a put or you write out a put and it expires worthless, you can collect the premium on that. I think that's right. I think I'm doing it wrong. A call, and then it expires worthless. You can collect the premium on that. You can also, if we talked about in the last video, we talked about shorting. You can you can, instead of buying a put option or buying a call option, you can sell a put option and sell a call option. All right, and this is just doing the didn't even need to do that. This is just doing the reverse. So if you sell a put option, then you're actually expecting it to go up. All right. And then the amount of money that you can make on it is a little bit different. I didn't make slides for it. And if I discuss it just verbally, I'm a visual person and I kind of have to see it. It's just not going to make money. Like the most you can gain is sometimes the premium. And then your downside risk is unlimited, just like it is with shorting. And it's again, when I make a video just about options, I'll put it in there and discuss how you can use it. But it's more of an advanced trading technique. You can also do spreads. You can buy a call and buy a put at the same time and trade the spread, which is the spread is just the range between the two prices. So you can buy a call at a strike price of $40 and buy our strike price of $40 or $50, and then buy a put at the strike price of $40, and then you're trading the spread being $10. All right, and then if the spread goes down, then you make money. So that's it. I don't have anything else to say. I'm out. I hope you enjoyed the video. I'll be posting some 1-minute videos throughout the week. If you have any questions or you have any topics that you want this covered, let me know. Next week I'll go over something different. Please ask questions because I don't want to be on here giving out information that nobody cares about. I don't want to be answering questions that nobody's asking, and I want to be as helpful as possible to people who actually are watching these videos. If you don't watch it, I don't mind. The information's out there. Some people I could recommend looking at if you're looking at trading at how I do is probably Rainer Teo, Teo. Oh, I need to link. I'll link both PowerPoints to this video, or I'll type it in the comment section so you can get both PowerPoint slides. And then I'll put some people that I look at that I actually watch. And you can watch them too. But those other people like Chris saying, nothing's wrong with them. I watched one video. He was suggesting some stocks. I mean, I knew about when you're actively trading, you just know about the stocks that, I mean, we're all looking at the same thing. So, I mean, I may not know about a large cap stock because I don't trade large caps mostly. But for the most part, if something's moving in the market and it's moving a lot and it's been moving throughout the week, then it's shown up on my scanner, which is what I'll talk about next week. I'll talk about scanners and a watch list and some other stuff. It's shown up. So I've seen it before. I've looked at it. And then if it keeps coming up, like GameStop has been moving all last week and the week before. So I'm looking at GameStop. Well, why is GameStop moving? So I know why GameStop is moving. I don't need anybody to tell. I don't need to go look at Chris Sane to know maybe I should invest in GameStop. All right. I know it's moving because I'm actively in the market. And that's what I mean. Like, you can take this information, and once you're in the market, you can get exposure in the market. And then once you get exposed in the market, you may not even, you don't need other people to tell you what you should trade or what you should be looking at. Those videos are helpful. They will give you information that you may not know. But I don't need anybody to, I can't say I don't need anybody. When I wake up in the morning, there's people I do watch in the morning. When I wake up in the morning, I'm looking at my scanners. I'm looking at what I'm going to trade. I start drawing out my lines like you saw me do at the end of the previous video. If you don't know what I'm talking about, you go to the very end of my previous video, I do a little bit of trading. I draw out my lines. I go into my positions. I come out of my positions. And that's why I want you to be able to go into the market, know what you're looking. When you're looking at a screen, let's go to a screen. When you come to a screen, let me go to a real screen. All right. So if I go to, this is on demand, this is charts, but let's go to my, why is it like this? Flexible. All right. And let's come off of this. Let's go to this. All right. Flexing. All right, sometimes I trade off of this. This is a standard deviation. These are like all my lines I drew on GameStop because that's what I was trading on Friday. All right, this is standard deviation channel. I sometimes y'all see some of the money I made on Friday in this account at least. I don't want this one. I want Flexi though. Why is it not going to Flexi? Oh, it may be because it's delayed. Oh, hold on. Let me see if I can get it on here on demand. And while we're here, if you're still watching the video, I'll try to show you, and I'll put a timestamp in here so somebody can fast forward real quick. Let's see if I can show, let's see if I can show, I know this is boring right now, I'm sorry. See if I can show you, time and sales. And if not, it's fine. Like this is my watch list, and these are scanners that I've set like momentum notification, super gap was gapping up really high, bingo. Like these are all things I put these in here because I want to actively look at these. This is a quick chart. Here, let me come off over here. I won't be able to show you unless it actually works. Go. I should have set it up earlier. What I'll do is I'll make a quick video and I'll show actually what live level 2 looks like and time and sales and my two charts look like. But like I want you to be able to. All my charts are spinning now. Boo, boo, Radley. Except for even that one. All right, let me come out on demand. And I can't show you my other platform because the other platform doesn't work on off hours. All right, so, but what I mean is, okay, this is level 2 again. I'm not trying to like show off that. It just happens to have my P&L from Friday on here. This is level 2, but this is a level 2 ladder. No, most level 2 doesn't look like this. This is the ask over here. All right, this is 8. The bid is over here. I'll do another video about this. This is the bid. The bid it'll have how many orders are there. All right, right here 62, 64. There's 200. These are in hundreds. 800. All right, so if you see like 20 on here, it's 2,000. If you see 200 on here, it's 20,000. No. Yeah. No. Yes. 20,000. I'm sorry. So if you see like a lot of numbers on here, it is like it's going to be a lot of resistance right there. And I'm sorry I didn't have this keyed up and ready to go. Let me see. I can't even get my charts to work, and it's probably because it's off hours. As you can see up here, it says, well, you may not be able to see because my face is up here, but it says delayed data. I'll shoot a live video while I'm trading, and I'll cover the level 2 and I'll cover the time and sales. But I want you to be able to look at this whenever you see people and they have like 6 screens up and stuff like that. You be able to look at it and know what you're looking at. Like up here, that's the P&L. P&L is profit and loss in the day. Your average price, your flat, your buy sell. That just tells you how many I bought and how many I sold. I'll go over a video on how you open up an account with TD Ameritrade and how you can trade with paper money or on demand. On demand just lets you trade any day of the week. I can go back and trade Friday and practice, or I can go through paper trading, which means I can trade during the current day and I can use like $100,000 and I can trade. It's delayed. It's like 30 minutes delayed, but I can use something like that. All right. But again, I'm just rambling. You can hop off. I'm about to hop off in a second. I know I've closed like 6 times. That's it. I'll go shoot a video real quick, or I'll shoot a video in the morning about level 2, and so I'll put that out first thing in the morning.